Hey friends, the biggest pay raise in history is here. On September 5th, the Japanese government announced a whopping 6.3% increase in the national minimum hourly wage, pushing it to 2,121 yen, the largest hike since 1978. This means 3 million workers will earn an extra 13,000 yen per month. Is this the government suddenly growing a conscience and handing out candy to the bottom tier? Of course not. So, my friends in Japan, hold off on popping that champagne just yet. And those outside Japan, don't scroll away because behind this wage increase lies central bank rate hikes, a bond market crash, hidden battles between China and the US, and possibly even a shakeup of the global money bag. I'm Luna, here to translate macro trends into numbers that hit your wallet. Today, let's break down why is Japan raising wages now? What challenges does this wage hike policy face? Will Yoshihide Suga's resignation affect the raise? And how will this impact the global economy? How should us retail investors prepare for the coming financial storm? We're rewinding 20 years, then fast-forwarding to a possible century rate hike in October to uncover what Japan is betting on with this wage quake, where Japan's economy is headed after Suga's resignation, and how exchange rates, grocery prices, job opportunities, and even global capital flows will quietly reshape each of our wallets. First, let's answer this. Why is Japan pushing such a regressive wage hike now? Do they really care that much about workers? Of course not. The story starts with a word gives Japanese people nightmares: deflation. After the bubble burst in the 90s, Japan fell into a deflationary trap. Companies went bankrupt en masse, became obsessed with cost cutting, failed to phase out loss-making businesses, and unions focused more on protecting full-time employees than fighting for raises. As a result, Japanese wages hit pause and stagnated for 30 years. Over those 3 decades, real hourly wages rose less than 8%. Meanwhile, in the US, they grew 60%. It gets worse. With prices not rising, companies not raising wages, and banks not lending, young people simply stopped dating and buying homes, entering a low-desire society. Honestly, if people have no money, who dares to spend when goods don't sell? Businesses don't dare raise prices or wages, creating a vicious cycle. The Bank of Japan's long-chanted 2% inflation target became a distant joke. From a base economic revival strategy, Abenomics, in 2012, to the unconventional monetary policy, QQA, in 2013, to the introduction of YCC, in Taiso YCC, every tool was thrown at the problem, yet core CPI remained flatlined. Then, in spring 2022, global inflation suddenly spiked. Oil, wheat, chips, everything soared. That year, the yen depreciated, causing import growth to surge in the first 10 months. Japan's imports grew 20.4% year-on-year, while exports only inched up 0.4%. Rising prices worsened labor shortages, and companies realized that without raising wages, they couldn't even hire part-timers. So, in 2023, the average wage increase hit a 31-year high of 3.89%. 2024 pushed further to 5.1%. 2025 went even higher. Last Friday, the minimum hourly wage was lifted straight to 1,121 yen, a 6.3% jump. Every prefecture will raise minimum wages by an average of 66 yen per hour. Don't underestimate those 66 yen. It's the government lighting a fire under society's bottom-tier inflation expectations. When wages rise, labor costs instantly go up. Convenience stores, restaurants, logistics sectors, dense with minimum wage workers, will have to pass those costs on to consumers. A 350 yen latte might become 380 next month. A 780 yen bento could break 800. As prices rise, unions demand more raises, which pushes prices higher, just like that. The Bank of Japan's dreamt of wage price virtuous cycle is finally awakening, like a volcano asleep for 30 years. By now, it's clear why Japan is raising wages. But as this wage-fueled volcano glows red, the first to get burned is Japanese government bonds. Because waking up alongside this volcano is interest rate hikes, the minimum wage increase gives the Bank of Japan new grounds to hike rates, heating up market expectations on September 3rd. As the central bank signaled hawkishness, Japanese bonds were sold off massively. The 30-year bond yield hit 3.29%, a record high. The 20-year yield touched 2.69%, the highest since 1999. The bond market's logic is cold and simple. Rising rate expectations make old bonds fall in value. So banks, insurers, foreign investors holding trillions in yen bonds face paper losses in this game. The slowest to react gets buried. Aid who can cut losses first. Stampede played out in Tokyo's financial district late into the night. Even the Bank of Japan is losing money. It holds over 50% of these bonds. So what's even more awkward is that the BOJ wants to reduce its bond purchases, but is afraid that if it pulls back, no one will buy bonds and the market will crash. If it doesn't, yields keep rising and interest pressure mounts. In the end, it could only say it will slowly reduce bond buying starting from fiscal 2026. Is this solving the problem? No, it's just buying time. If the bond market is an internal injury, then U.S. tariffs are the external knife stabbed in the back. The U.S. government imposed an additional 15% tariff on Japanese imported goods. Just take cars. For example, they account for nearly 30% of Japan's exports. Last year, Japan exported 1.3 million cars to the U.S., making up 35% of its global exports. With a 15% tariff, Toyota, Honda, and 7 other major automakers are set to lose too. 67 trillion yen in profits in fiscal 2025. Toyota alone said its profits would be slashed by 1.4 trillion yen. In July, Japan's car exports to the U.S. plummeted by 28.4%, worse than June's 26.7%. As Japan's largest export market, the U.S. saw imports of Japanese goods drop by 10.1% year-on-year in July. Meanwhile, pre-tax profits for transport equipment manufacturers nosedived by 29.7% in the second quarter. Automakers are the barometer of wage hikes in Japan's annual spring labor negotiations. With profits being devoured by tariffs, how can they meet the union's demand for a 5% wage increase? Smaller downstream suppliers have it even worse. Factories that subcontract automakers rely on minimum wage workers to keep costs down. Now, with wages rising and tariffs added, they're being squeezed from both ends. Data from Tokyo Shoko research shows that in the first half of 2025, 172 companies went bankrupt due to labor shortages plus rising costs, a record high. The head of Tokyo Shoko research loudly warned the impact of U.S. tariff policy is becoming increasingly unpredictable. Over time, more companies are growing concerned about the effects of tariffs, especially in manufacturing and export-related industries. And the Cabinet Office is so anxious that it slashed its export growth forecast for fiscal 2025 from 3.6% to 1.2%, and reduced its business investment forecast from 3% to 1.8%. The economy minister even stated bluntly that this wave of US tariffs could shave 0.3 to 0.4 percentage points off Japan's GDP growth, no small number. At the same time, when it rains, it pours. Japan's domestic political scene is adding to the chaos. Yoshihide Suge's Liberal Democratic Party suffered a crushing defeat in the upper house election, and the ruling coalition lost its majority in both chambers just yesterday. Japanese Prime Minister Yoshihide Suga announced his resignation as a result. The new government will need at least 3 months to assess new policies, which will definitely delay interest rate hikes. However, the market had already priced in an October rate hike. So if that doesn't happen, the yen could instantly depreciate, inflation could resurge, and the newly ignited wage price spiral could be snuffed out. The bottom tier's newly increased 6.3% wages would quickly be eaten up by rising oil and grocery prices. Even more dangerously, the probability of a Fed rate cut in September has soared to 99%. If the US-Japan interest rate differential reverses, the yen could weaken further, export companies would be hit again, and Japan's GDP could slide directly into recession. Meanwhile, unions are still locking horns with companies. The largest union has secured wage hikes for 2 consecutive years, with this year's increase hitting a 34-year high of 25%, but small and medium-sized enterprises simply can't handle it. SMEs are the first to bear the brunt after across-the-board wage hikes, costs rise, and they were already struggling to make a profit. Now, things are even worse in remote areas like Kochi and Miyazaki, where hourly wages barely exceed 1,000 yen. The risk of business bankruptcy is much higher than in big cities, and exporters are in an even tougher spot. already suffocating under tariffs, and now they're facing even greater difficulties. Here, some might spot the problem with bond market internal injuries and tariff external knives. Can Japan's wage hike proceed smoothly? And since the minimum wage hike supports wage rate hikes, but Suga's resignation delays them, will his resignation affect the October raise? My answer is the wage hike policy will continue, and this raise is a long-term goal pushed by the government and business world, a new PM, and government will likely continue it to improve livelihoods and spur economic growth. While Suga's resignation and the new PM's need to handle party unity and policy continuity might cause some disruption. If the new government maintains stability, the October raise should proceed. At this point, you'll see this 6.3% minimum wage hike isn't just a government handout. It's Japan betting its national fate, igniting inflation, pressuring the central bank, countering the U.S., and awakening an economic cycle asleep for 30 years. Win in Japan escapes 3 lost decades, entering a positive loop of wages, prices, investment, and birth rates lose, and the bond market crashes. Companies go bankrupt, politics turn chaotic, and the global economy shakes. And Japan's current political turmoil adds fuel to this critical economic reform moment, making everything more unpredictable as observers. We might not decide whether Japan hikes rates. The raise doesn't directly affect us, and political turmoil sounds like distant news, but we can understand the logic early and protect our wallets. Yesterday, Suga resigned. Today, the yen fell instantly down 0.7% against the dollar. Early session. The already pressured Japanese bond and stock markets saw bigger swings Monday, with global worries over Japan's fiscal deficit and Suga's domestic political pressure. Ultra-long bond yields had already lingered near record highs, and the Nikkei slid from last month's peak. Suga's formal resignation could ignite these long-standing worries, sparking short-term market volatility. Thus, with the LDP lacking a clear majority, investors will stay cautious until a successor is named, keeping the yen, bonds, and stocks volatile. Short-term, the yen will weaken and Japanese bond yields will rise until a new leader is clear. So, who succeeds Suga is crucial. Right now, Sane Takabichi is a top contender in the LDP race. She believes in Abenomics, supports the Boge keeping, ultra-low rates, and wants more government spending to aid recovery. If Takaichi takes over, rate hikes will be delayed further, and the yen will weaken more. The bond bear market will worsen, but it'll benefit Japanese stocks, even U.S. stocks, to some extent. If Fumio Kishida comes to power, he'll continue Suga's wage price cycle, but still delay rate hikes to December. So we can see whoever takes charge, keeping the economy stable is the top priority. They'll support business wage hikes and delay rate hikes, meaning the yen carry trade can continue. What's the carry trade? Simply borrow cheap yen, convert to dollars, buy higher yielding stocks. Tech stocks will stay strong with sustained inflows. Consumer stocks, especially those with big Japan operations, will benefit from local spending upgrades. So high dividend stocks will attract yield-seeking Japanese investors. But note, political uncertainty could spike short-term volatility if Japan's politics shift again. Funds might briefly flee to safety. A weaker yen and bond bear market are unavoidable. This isn't small for global markets either. Japan has the world's 3rd largest bond market if Japanese yields keep soaring. U.S. and U.K. 30-year yields have already followed. On September 3rd, the U.S. 30-year broke 5%. The U.K. hit its highest since 1998. If Japanese bonds keep falling, emerging market bonds will be hit, making the whole world nervous. So how should us retail investors position based on past trends? Luna's survival guide for ordinary folks has 3 key tips to dodge this rate hike and PM resignation storm and find opportunities. First, focus on us tech and consumer giants with big Japan market share. They'll gain from Japan's wage hike and carry trade inflows. Second, high dividend blue chips are a good choice and most attractive to Japanese investors. Less volatile. Third, don't put all eggs in one basket. Diversify across sectors to enjoy inflow benefits while hedging volatility risks. Lastly, watch the new Japanese cabinet's policy moves closely. If policies shift, adjust strategy fast. Markets always change. Staying flexible lets you seize opportunities in volatility. Guy history doesn't spoil endings, but it quietly rewards those who read the signals. I'm Luna, here to translate macro trends into numbers in your account. Finally, I want to ask, When will Japan end its 3 lost decades? How will this political shift affect Japan's deflation? And are you ready for this financial storm? Share your thoughts below and don't forget to follow me. I'll keep updating on both moves and Buffett's investments in Japan. Latest news first. See you next time.